Market volatility has picked up amid uncertainty over U.S. trade policy, but how should investors approach asset allocation in this challenging environment? Joining us now to discuss is Jing Roy, VP Director and Portfolio Manager for Asset Allocation with TD Asset Management. Jing, always great to have you in the program.
Thanks for having me.
There's lots going on. Let's just try to break it down right off the top about this uncertainty in the markets and really what's the root cause of all this?
Well, it's really the tariff and the recession fear that's creating a bit of anxiety in the market, and we see that the stock market globally has entered a bit of a soft patch. So when it comes to tariff, we know that U.S. is expanding the scope of the tariff. That's spooking the market a little bit. Come this Wednesday, the dragnet of a reciprocal tariff will actually catch about the dirty 15 countries. So those are the countries that make up about 90% of the U.S. imports. So that's quite a few countries. And the tariff rate can range around 5 to 25%. So it's a very wide range. And when we have tariff, they tend to reduce the growth of the economy and increase the inflationary pressure. So I think the risk of a stagflation narrative is increasing. As a result of that, markets do not like that.
Yeah, and apparently President Trump today is saying that the reciprocal tariff is going to be on all of their trading partners, and just not the largest one. So there was a lot of stake here and a lot of moving pieces. So let's talk. That's the backdrop, nicely broken down. Asset allocation amid all this uncertainty, and maybe even some potential opportunities in the different asset classes. We want to start with equities. Let's start breaking them down. But we'll go with the equities first.
Yeah, maybe before we go into equities, let's talk about a big themes that we look at when we try to frame the asset allocation decision. So there's three themes. Number one, we don't think the tariff is actually going to lead to a very deep global recession as long as it does not spread from goods to services. Number two, the asset classes will have dispersed return because now it's more policy-driven, depends on the country, and the sequence of that policy action will actually affect the asset returns. And lastly, in the longer term, I think investors can look forward to higher returns because when we enter a deglobalization period, there's a higher need to invest in the self-sufficiency of each country. So what they want to do is to invest to increase their productive capacity and defense capabilities. As a result of that, there's more demand for capital. So in the long term, the return will go up for investors.
Oh, so there is potential
here.
There is
potential. There's
potential.
Always a silver lining. Then moving on to the equities. Within equities, we still remain constructive on equities. And we see, the hunting ground for equity returns are really more numerous outside of the U.S. nowadays. Even though U.S. is imposing tariff on Canada and Europe, that doesn't mean the equity return in those countries cannot be better than the U.S. This is because, there's policy levers in those two regions that can help offset the growth weaknesses. In Canada and Europe, I think there's more political will and a policy space to try to ease that transition. And also there are also countries, like Sweden and Norway. They're not really affected by a tariff, but they are the beneficiary of EU's fiscal spending package and the monetary easing. So for equities, we remain constructive at this point.
Okay, so there we go. Some places for our audience to look into. What about the bond space? How would we expect bonds to react in a climate like this?
When we look at bonds, what we want to achieve through a bond holding is really the capital preservation potential and the income potential. So we want stable income from those bonds. And I think IG credit, which is the investment grade credit, can still achieve that purpose for us if we hold them to maturity. As I mentioned, because we're not expecting deep recession, as a result of that, we are not expecting widespread corporate defaults. So your capital is safe when the debt matures, so you get your capital back. At the same time, the yield on those investment grade bonds is actually quite attractive and help you stay ahead of inflation. For example, in the US, the IG credit is yielding north of 5%. In Canada, it's north of 4%. So it's pretty attractive.
Equities, bonds, the two big asset classes. But in this environment, I've heard a lot of conversations about commodities and alternatives. What's the thinking here?
Well, it's very important to diversify your portfolio, especially when the outlook becomes a bit murky. When we talk about a situation where growth slows down, inflation pressure ratchets up, and people will hark back to 2022. That was a very traumatic experience for especially conservative investors because bond and equity both went down. To fortify our portfolio against that situation where inflation becomes a main narrative of the market, we want to make sure that we have inflationary hedges within our portfolio. To do that, commodities and infrastructure assets actually provide a very good alternative asset to diversify our portfolio, and at the same time provide diversification so that the gains from those assets can moderate the losses elsewhere in the portfolio.
When I think about our focus right now as investors, I mean, we're all looking at Wednesday and the next round of tariff announcements, and it's important, and we should be focused. But as we start to look going forward outside of that, what potential catalysts could be on the radar for you?
We have quite a few negative catalysts so far, but there's something good to look forward to. As I mentioned, we have lots of policy tools at our disposal. For example, there's a lot of fiscal space in Europe, especially Germany. As a result of that, they're able to tap into that to increase the fiscal spending and use policy tools to attract foreign direct investment to offset the domestic weakness in investment and consumption. That's one way of doing it. And on the monetary front, because inflation is coming back closer to central bank targets in a lot of regions. As a result of that, central banks will be able to more aggressively cut the rates to support growth. Maybe map it back to the regions, starting from U.S. On the policy front, we know that there's a fiscal package on the docket. The fiscal package is supposed to be enacted by July before the ex-date in August. So in that package, the Trump administration will look to have new tax cuts and potentially extend the 2017 tax cut permanently. And that will add about 100 basis points to the GDP growth. So that's a positive, but it takes time to materialize. And in Canada, while it's very catalyst rich, we know that federal election is coming up, and that will really reduce the political uncertainty within the country. And both Liberals and the Conservatives parties are actually campaigning on very pro-growth fiscal policies. So no matter who wins, there's going to be change in policy to support growth in Canada. And we know that our inflation is very close to the 2% target now. As a result of that, Bank of Canada will be able to hold the policy lever to help ease the transition. And in Europe, if there's a ceasefire in Ukraine, then the energy price can potentially fall. And that will give the ECB, the European Central Bank, more policy room to cut rates to support growth.
So obviously there are things on the horizon. There's a lot going on in the day-to-day. It's hard sometimes not to get weighed down by those headlines. Let's just round back to diversification and why it's key in this environment.
Well, maybe I'll start with an analogy. I haven't experienced this personally, but during the tsunami, what you should do is to head towards the wave and head out to deep waters. And this is because the energy is spread across a bigger mass of water, so it becomes less destructive in the process. So in our portfolios, instead of deep waters, what we have is diversification as a tool for us to, kind of navigate the waves of uncertainty. So in terms of diversification, what exactly is it? It's essentially tapping into different sources of return that's not correlated with each other, so that one asset goes down, the others are performing as they should because they're not correlated in a way. Maybe give you an example of diversification in action. Year to date, Tesla is down about 40%, but a well-diversified portfolio containing 60% global stocks and 40% global bonds is down, less than 1%. So this is the benefit of diversification. And as a rule of thumb, when, we need more diversification in the portfolio when the investor is more risk averse and the outlook is more cloudy.